for being here as always. Shibani Sircar Kurian is now joining us. She's a Senior Executive Vice President and Head Equity Research at Kotak Mahindra Asset Management Company. Shibani, good to have you with us here. Great speaking with you this Friday afternoon. The funds are doing fantastic, right? I mean, I was looking at not mutual fund returns, but PMS returns. Monthly, we're talking about early double digits for 1 month. And this is now true for the last 2 months or so. I don't know what kind of returns your small cap, mid cap funds, etc. are delivering. But where are we at now in this re-rating cycle for that part of the market, mid caps and small caps? Are we closer to the highs, or you think there's still a long distance to go?
Yeah, hi Prashant. Good afternoon. So when you look at markets, Indian markets by and large have been far more resilient than what was earlier anticipated. So when we started off this calendar year, our markets were underperforming. However, a lot of that underperformance vis-a-vis the emerging market pack has been erased in the last couple of months. And as you rightly pointed out, the mid and small cap basket has outperformed in this sort of an environment. Two key factors have been driving markets in India. One, on the macro front, I think India clearly stands out, not just on growth, but also now in terms of an external sector as well as monetary policy, where our real interest rates are positive, whereas developed markets, you are still seeing a fairly loose monetary policy. So there is room from that perspective. The second factor, I think, has been the earnings season, and the earnings season turned out to be fairly good in the sense that there were no major disappointments, and earnings delivery was largely in line with estimates. So I think that has been very crucial in terms of the way the markets have moved. Now, when you look at mid caps as well as small caps, when you look at mid cap valuations vis-a-vis large caps, and if you look at the mid cap index versus Nifty over the long period, in terms of valuations, the mid cap index is still trading at above long-term average levels. While the small cap index, while I don't know whether it's a very comparable number over a long period of time, small cap has come closer to long-term average levels. So from here on, we believe that delivery of earnings for the market is going to be extremely crucial. Market valuations at a headline level are fair value range, and we've come back to long-term average multiples, and even our excess vis-a-vis the emerging market pack has also been erased. So market valuations are fair, but for markets to move up from here on, earnings has to come through. If you look at consensus earnings estimates for both FY24 and 25, consensus is still building in about 15 to 17, 18% earnings growth over the next 2 years. So that's our view, that markets are at fair value range right now. Slight preference in this market for large caps over mid and small caps.
Shibani, afternoon. We always end up talking about the big sectors like banks, and we know your view there. You've been bullish on the banking space, on IT. I want to go a little deeper into other sectors, say something like textiles, oil marketing companies, gas companies, liquor companies, tires. There are so many other themes. Can you tell us some of these other themes that you're bullish on and why? Where structurally there are tailwinds.
Yeah, so you've mentioned a lot of sectors which are fairly diverse in nature. So when you look at our portfolios, so let's start maybe with the overall portfolio construct. What we have really done is looked at sectors where earnings growth is visible, and what we believe is that the domestic facing sectors are seeing far more visibility on earnings over the next couple of years. So in that space, banks, as you rightly pointed out, we've been positive on. But within the other segments, auto ancillaries, industrials, capital goods and cement have been segments where we have been positive on. Cement, for example, if you look at current structure of the industry, one, you have seen market share shifts and consolidation. Secondly, volume growth in terms of delivery has been extremely strong, where both infra and housing has contributed to the growth. Thirdly, if you look at input cost pressures have come off sharply, and from next quarter onwards, you should start seeing margins expand and therefore overall profitability expand. So that's been one segment we've been positive on. On the oil and gas space, of course, that's a sector which has been very cyclical and difficult to predict. But structurally, the gas utility plays are something that we believe from the overall fuel perspective seems to be where we have placed our bets on, and therefore the gas segment is where we have been positive on. Apart from that, real estate and home building have been some other spaces, specifically the home building space. So cement we spoke about, so other segments such as pipes, ceramics, tiles, plywood, these are some of the other areas where we are positive on in our portfolios.
Okay, that's quite a list. Shibani, hi, good afternoon. Surabhi here. Gives us plenty of food for thought. Let me just recap. So, banks, of course, you mentioned capital goods, cement, related space would be home building, pipe companies, gas utilities. Did I also hear real estate? As in, do you have a house call which is positive on realty per se as well?
So we've been positive on the real estate space. Of course, stocks have moved up quite sharply and therefore valuations have to be taken into account. But structurally, when you look at the real estate sector, this sector has been again a beneficiary of consolidation where market share has clearly moved towards the larger organized developers. Policy changes have also helped significantly from that perspective. The interest rate cycle, when it was benign, affordability moving up also resulted in a lot of demand coming through, and therefore the excess supply that was there has been largely absorbed and inventory levels have come off. Of course, in this segment, what we have also seen is that premium segment has done better and therefore demand has been strong. I think right now, given the valuations, what we have seen is while the developer base or the real estate pack has moved up, the home building segment has lagged. However, once you start seeing a lot of these sales translate into, people starting to move into their houses, a lot of the home building sector and demand should also start to pick up. And that's where we believe there is an opportunity set at current valuations. So what we are really doing across our portfolios is looking at opportunities in terms of growth earnings, but very mindful of valuations in the current market.
Yeah, but have to grudgingly pay higher multiples, right, if you want to buy. And no choice.
Yeah, so in some pockets, yes. But, we are not in the camp that you will buy growth at any price. What we try to do is growth at reasonable price. But yes, at some points, you might have to grudgingly pay slightly higher valuations.
Any thoughts on, we had the management of Angel earlier. Angel won. Stocks done very well, actually. This going down the financialization theme, that's been a very powerful and I don't want to say secular because it's just been a few years. Maybe it will be secular. But do you own any of them? What segment there?
So I think you're right. The financialization theme is actually secular in nature. So, of course, in a secular theme, you may see some ups and downs here and there. But again, in this segment, while I don't want to specifically talk about a particular stock, but what we have really seen is, again, market share shifts have been extremely stark, right? So people or players who have been able to innovate, have been able to incorporate technology in terms of their overall business strategies, have been able to gain market share. And that is what is reflective in some of the names. Overall, if you look at our portfolios and the segment, financialization of savings is something that we think will continue. Of course, market movements here and there will impact some of these players, but as a structural theme, this is something that should continue. And those players who have been able to gain market share in the segment should be better off in this particular space in the broking industry. But a lot of disruption has already taken place.
Oh, yes, absolutely. It has. So many different shifting trends. Yeah, I think Angel One was telling us that a lot of their transactions, as high as I think 90%, are happening on the digital mode, on the mobile, on the app. So we live in a new world, absolutely. Thank you very much for joining in. You have a great weekend, Shibani, and we look forward to our next conversation. Well, quick break.